Well, good evening. Welcome to this live stream on the 19th of August, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you very much for taking some of your time out on a Tuesday. It's really appreciated. And nice to see the people in the chat, some new ones, and some people who've been around with us on the journey over the last few years. Great community here. So thank you very much for spending some time. Just before I bring Tony in, let me remind you, as I always do, that we're not providing specific financial legal advice. It's a general conversation only. We moderate the chat, but feel free to throw your questions and comments in. I won't necessarily follow them all because there's just so much going on. But if you use that walk the world, then that'll get into my queue. And if you've got a specific question for Tony or myself, if you use the walk the world monocle there, it'll come in and we can then get into the show. I've also enabled Super Chat, which means if you want to make a contribution to what we do around here, greatly appreciated, or indeed get your question to the top of the list. That is always a way to do it. And of course, as with all of this stuff, if you've got specific burning issues you'd like us to talk about, feel free to put them in the chat. Now, just before I bring Tony in, I will just mention one other thing. I've got a poll on at the moment, and you can see there in the YouTube. And if you look at the go there and there. There you go. Tonight's poll, just to say that tonight's poll is all about investing. And what I was interested to do was to try and understand a little bit about how everybody here is thinking. So the poll has four answers. My financial investments are mainly in a managed super fund, so that's one where somebody else is managing it, or mainly in a self-managed super fund, that's where you're managing it for yourself, or you're actively invested outside super or in addition to super, and invested, meaning long term, for actively traded outside super. And I'm going to get some answers up a bit later because I want to chat with Tony specifically about the difference between investing and trading. I think that's a very valid conversation to have at the moment, particularly with things where they are. Anyway, with that, put the answers in the poll. We'll bring it in later, but let me bring Tony straight in. Tony, welcome. Great to see you again.
Oh, fantastic to be back, and great to have all the viewers that have followed us on this journey. And I was just mentioning, Martin, that we've been doing this coming up to 7 years now, which is insane, really. And I was just talking about we've only had a couple of technical gaffes, once when my battery ran out and something happened to your system, but so far so good, and we're getting through it. And what we've noted is that what's kicked the can down the road or delayed the inevitable has been when Labor lost the unlosable election and the global pandemic, when interest rates went to 1/10 of 1%, and the mainstream brigade was saying interest rates will never go up again during our lifetime. So here we are. The message is largely the same, but I think things have certainly gotten a little bit more difficult.
Absolutely. And in fact, Cookie Boy's just come up and said October 2018 was the first interview. So there you go. Time flies. But
I
it's fascinating, isn't it, that some of the thematics are still very much the same, only I would say more so because people are more indebted. The asset bubble has bubbled up even higher. And when you start thinking about some of the consequences of that, then you've got to ask the question, well, where does it all go? And more importantly, of course, how should investors or traders think about what's going on at the moment? And of course, you've got very much a rounded view on this, Tony, because of your experience and because of the fact you've been in markets for a long, long time. And I think very importantly, you understand some of these market dynamics.
Yeah, I've got a saying which I mashed up, that fear is temporary, greed is perpetual, and human stupidity is infinite. And I've been a stockbroker for coming up to 27 years now. And later in my slideshow, there was something that I've never seen before that I saw in the market yesterday. And I look forward to talking about what happened with one stock. But largely, I think it's all about psychology. It's all about dopamine, adrenaline, the gambling nature, people addicted to their phones, porn, cocaine, expensive stuff, and how it's affecting the attention spans and the ability of people to invest for the longer term and be patient. So, yeah, no, look forward to the slideshow, and I'm ready to go whenever you are.
Okay, just before I let you go off on your long run, let's just put a couple of contextual slides up. I thought this was quite interesting. This is actually just showing you that the price to book ratio on the S&P 500 is now 5.3 times. So that's higher than where it was back in 2000 at the dot-com bubble. Of course, it dropped dramatically down to 1.6 times. And the other quite compelling story here is if you look at the NASDAQ, the market cap is 145% of US M2 money supply, which is pretty much as high as it's ever been and way higher than where it was in the dot-com bubble, right? We've also got, of course, global public debt going through the roof with not just the US, but China and pretty much all the other countries still throwing liquidity into the system. We've also got the situation that the S&P 500 is supported by roughly 10 companies, mostly the high tech comps, as you perhaps would expect. And you've also got this little issue that this time of year, August to October, we tend to go sideways rather than anywhere else. So when you put all of that together, Tony, I sort of sit here and think, we are in interesting times.
I think, if you had to use one word to describe it, it's called complacency. And sometimes during bull runs, we neglect to check the S&P 500, the Dow. When gold stocks are flying, you'll neglect to check the gold and silver price. But I think we're in this little period where those that have the courage to bet against the markets, now is the time to do it. We had quite a savage correction in the US markets, and that's where some of my clients got back in the game because we found our instruments had performed extremely well, and there was a time to sell it and to buy it back. And I think there's this belief that markets will never fall, assets are going to be overpriced during our lifetime. But I think that's an element of infinite human stupidity, because markets are going to revert back to the normalized PE ratios. And believe it or not, people, they're going to overshoot to the downside. And I remember prior to the GFC, the argument in Australia was that the influx to self-managed super funds and larger super funds would fully support our market, but our market pretty much halved, and that was fueled by a margin lending bubble, and then margin lending levels fell off a cliff. So markets are globally overvalued, well above historical norms. They will correct. I'm not saying they could. They will, and it's just a matter of time. And this tiptoeing through the tulips, this isn't the new norm at all. And it only takes, honestly, a couple of negative nights in the US and the press machine will go into overdrive. So we're on the cusp of some 1,000-point down nights on the Dow. Admittedly, when you're coming off 45,000, they're not that scary, but these falls are going to happen. We saw the circus in Alaska. We see how the US is decaying. It's taken over by cheap drugs like fentanyl. You still got a lot of violence. You still got a lot of stupidity. They've still got their worshipping of celebrities. I saw today in Las Vegas, a fake Justin Bieber was actually paid to perform as Justin Bieber. I mean, stupidity will roll on, but suddenly, once you get a bit of a correction, you get a little bit of fear, markets tend to revert back to the norm, and we'll start paying attention to PE ratios and earnings. And I have a saying that eventually music reverts back to guitars, bass, and drums.
Yeah. Well, I was around through the dot-com bubble, and I remember just before the bubble fell, how everyone was saying, it's different this time. This is a whole new paradigm. This is a whole new way that the world is going to work. So we have to have new multiples and new valuation mechanisms, et cetera, et cetera. This is going to be a revolution. I actually was involved at the time with working inside a bank, and I was trying to tell them about the fact that the long-term strategic impact of the internet was there, but the short-term hype was massively overdone. And that was before the dot-com crash, as it were. And of course, people didn't believe that markets would come back, but they did. And I rather feel a bit the same at the moment with the AI story. Now, I think AI is important, but I don't believe it's as important as the markets are thinking it is. And like I said, 10 stocks really are driving the S&P 500, which sort of, puts a little bit of an uncomfortable sense in my mind, Tony, about what may be happening ahead. But of course, the title of this show was Can You Handle the Truth? Which I think is a good way to segue into your slides, because that is really the big question, isn't it?
Well, I think you summed it up perfectly, Martin. The four most expensive words in history are "this time is different." The three most expensive words in history are "I love you." And the two most expensive words in history are "I do." So you're absolutely spot on. I was a stockbroker during the dot-com bubble. I was writing $120,000 a month in commissions. Stocks were going from 2 cents to $6 on a website. And one day the hair stood up on the back of my arms and I thought, this is just a complete crock. It's all going to end in tears. And it did. And it's not a new paradigm. I actually downloaded Grok. I put a picture of my Akita in it and I made a funny video out of it, Martin. But that's not the future, because I've done it twice and now I'm bored with it. So anyway, let's get into the slides, guys. Here are some I prepared earlier. There's a disclaimer. I'm going to make forward-looking statements. That's basically to cover my backside. This is not personal advice. I don't know your situation. If you want to talk to me about personal advice, send me an email. I still have some capacity to take on people. Anyway, we look at the world, and this is what united the world recently. That kiss cam at a Coldplay concert, it seemed to provide the most unity I've ever seen on the planet since Hot Tour Girl and that infamous interview that was concocted. So that brought out lots of memes, it brought out lots of humor, and I thought, yeah, it's great. Let's not worry about our problems. Andy there was threatening to sue Coldplay. I just think if you're having an affair, don't do it in a public place. But I think really what has united the world now, and I'm all for it, guys, is Sydney Sweeney. Yeah, not only is she wearing great jeans, I'll leave the rest up to your imagination, but it's amazing how a simple shift back to the traditional beauty has sent the woke brigade into an absolute frenzy, and we have the purple haired nose ring, people going completely bonkers. And I think this is a feel-good story, pun intended, for everyone, but just is amazing to show what can happen once something like this comes out. And speaking of Sydney, that has to be, I think that pretty much sums up the shit show we're now living through. You can see there that the median price is up to about 1.63 million, and there's been no wage growth. And I know that most of the people that watch this show tend to be around my age, but if you're part of the younger generation, here's my example. So in 1993, I was a police officer in Bondi, earning $48,000 a year. I bought my one-bedroom unit, walking distance to the beach, walking distance to Bondi Police Station for $115,000. I remember my monthly repayments were about $800 a month. And as you can see there, now a rookie cop earns arguably up to about $100,000 a year. And that same one bedroom apartment would now sell for $1.2 million, then you can add stamp duty. So people might say, well, Bondi is a much better place. Well, I say bullshit to that, because when I was living in Bondi, I could walk down to the beach, just my wetsuit, my board, surf, relatively uncrowded waves, go back to my $48,000 a year job. Um, Obviously, I was in fairly good shape then, and then I blew out like the US trade deficit. But as you can see, that has really changed how we live, and that's real. And I think Bondi now has become more chai latte, overcrowded. I think you've even got a Chemist Warehouse now on the beach front. And I look back into about 1994, where my parents sold their house in French's Forest for 440,000. That house now would be worth about 2.6 million. I actually went back to the house about 6 years ago and had a tour. But over the long term, I think that growth is only about 6%. So you can see that the explosion in this housing stupidity has only occurred recently, but those figures are real. When I was in the police, obviously my McDonald's was free or half price. It was easy to eat takeaway food. It was easy to go out and gamble, drink, and do all those other things. But that is a real shame, and what the youth of today are up against. And it really hurts, because a large proportion of anyone's income now is just spent on shelter. I mean, my unit was it was shelter, nothing more, nothing less. And I think I was going through X, and I saw this house purchased in Mount Druitt for $6,000, and the person who bought it was earning $8,500 and raised six kids in it. I mean, these days, the chances are you might be close to a meth lab, but that just goes to show that that house now would probably fetch $1 million. Yet someone who had six kids was able to live out there and raise a family and probably have enough money so the mother didn't have to work. I went back and had a look at the video, and she did do some part-time work as well. And I think the tweet on the right, it just shows how ridiculous life has become. You go to the Ekka show in Brisbane and help yourself to a $55 burger and chips, and heaven help it if you're gluten free these days, because they just slam you extras, and that's ridiculous. And I notice that when I take my kids out to the AFL, we're quite regulars at Optus Stadium. It certainly adds up, but that's how sad things have become. Not only have we've had price to income ratios, long term go from 4 or 5 times out to 14 in Sydney just to live at East Broken Hill. I just think it's sad, and I don't think it's the answer, guys. So I'm about to put a fork in it, just like the Collingwood Magpies grand final hopes for this year. Now, I think it's not often that we look across the ditch, but this was from February this year, and it just shows that New Zealand house prices were starting to come off quite badly. That's quite a decent drop. And I make no apologies, Martin, for stealing one of your slides that shows that Auckland's down 23.6% from the peak. And I think that that's only going to get worse. And if we look towards Canada, I think Australia's probably going to get the bronze medal when it comes to housing bubble collapses. So I know we've been saying it for a long time. There's been a lot of factors that have delayed it. As I mentioned, the 2019 election. And it was funny, I got the program for the Resources Rising Stars conference today. I think it's on the 16th and 17th of September up at Royal Pines. And Stephen Koukoulas, the infamous economist, is actually closing the conference. And long-term fans of this channel will know that I made a bet with Stephen that the housing market would fall by 35%. He offered me very generous odds. And prior to COVID, the funny thing was I was actually on track to lose that bet. And then suddenly the pandemic hit. We had interest rates go to zero point 0.1, and I ended up losing that bet. And I guess though that the losing that bet, the pain was kind of taken away in the fact that I could fix my 5-year mortgage at 2.64. And it's just funny how quickly life passes you by, because I've only got about 15 months left of that beautiful rate. But anyway, New Zealand is showing signs of a major collapse. If anyone thinks we're better and smarter than them, I could assure you, think again, guys. So yesterday was just a regular day on the stock market, and this little stock called Kaylee Resources opened up at 4 cents and peaked all the way to $3.18 intraday. That stock increased 87 times at the peak. People would say, well, have they got a cure for cancer? Have they got a cure for high house prices? Have they got a cure for immigration and student numbers? No. This stock ran because the top 20 control 94% of the company. FOMO took over. And if you have a look at the top 20, you'll see what I mean. So anyway, that's the first time I've ever seen a stock increase 87 times. So let's just say you bought, well, this isn't going to happen, but let's just say you had 100,000 shares, you bought at 4 cents. At one point, your $4,000 investment, if you sold at the peak, was worth $318,000. So I think the ASX has issued them with numerous speeding tickets and a massive please explain. But what I can say is that the company, if they've done everything legally, they cannot control human stupidity, FOMO, greed, technical trading, bot trading, and there's no reason why they shouldn't be allowed to continue to trade. But at the time of the company going from nothing to over $300 million market cap, they were about $4.9 million in debt and had about $15,000 in the bank and some moose pasture. So that's something I've never seen before in my 27 years in the broking industry. And we're coming to the end now. For those who have binge, I strongly suggest you watch that show, Who Broke the Australian Dream. It's on buying a house, renting. I think it's one of the most well put together programs on the housing crisis in Australia. Highly recommend it. I wrote a review on Twitter, so check it out, guys. If not, try and find it online. Mr. In Between is the best mini-series I've ever seen in my life. That was on binge. I think it's now on Netflix. And Martin, you have doggy cam. I needed a slide. That's my 13-year-old Akita. His name is Colin, named after the dog in Colin from Accounts, formerly known as Achilles, and he's my best mate. So I'm walking him 3 times a day. Hopefully, I've got a few good years with him left, but no, he's my best mate. I love him to bits. And this quote really resonated with me, guys, and I think it speaks for itself. And that's where I tend to get a little bit sad for this generation. My 22-year-old son and his girlfriend moved to Perth from Tasmania. He's going to be lumbered with to build a house and land package about 40 minutes from the city. He's looking at living with a $650,000 mortgage. And heaven help us if we ever see the average mortgage rate of about 9.1% hit this country again, or the long-term average RBA cash rate ever gets anywhere near 6.4%, because I can tell you that the interest alone is almost going to be the medium wage. And that's just no way to live. And it's right. We don't have aspirations to have a boat or drive a Lambo. I think, we do get a little bit of FOMO, but we just want to be comfortable. We just don't want to worry about money. And, this period of absolute nonsense where house prices, rent prices. I saw a tweet recently, Osborne Park, a suburb around where I live in Perth, had 94 people queuing for a rental. People can't even get a place to live. People are renting out garages. There's mold. Landlords won't fix up these shitty places. So I just think that when the inevitable happens, people are going to regret their decisions to go out and overextend themselves and are in for a life of pain. And I think that's where it's all going to come to an end, unfortunately, for many. Life goes on. There's a chance for people to rebuild. But I tell you what, you can put as much shit as you like on the boomers, but they've just played with the rules. They've played by the rules. And it's not their fault that we had a global pandemic. We've had record low interest rates, and that 10 grand house that they bought is now worth over $1 million, because I know now that you need to really look at where you're going to be. You need to look at your earning potential. But I know once you're under financial stress, it's near impossible to go out and get second and third jobs. And that's all, folks.
Yes, thank you very much, Tony. That was very, very powerful. And for me, I think it really just underscores the precarious nature that we've created for ourselves. And when I say we've, it's not those buying property, it's the structural norms within which we operate, which are driven by high government debt and also, of course, by the stupidity of high migration and all of those other things that are actually together stoking the momentum. But it is an unsustainable momentum. And New Zealand, I think, is a very important archetype of what may happen ahead. Because the bottom line is, of course, that the trajectory, because it's unsustainable, may well turn. But if it does turn, it could turn quite quickly. And perhaps it'll be, as you said, and I think this is a very important point, one or two things somewhere around the place could actually be a sufficiently strong trigger to be able to actually make this thing way wobblier than it is at the moment. And I always see, the governments putting their finger in the dike and trying to stop this and this and this. We've got to keep the high migration coming in, all those things. But it's not going to take much for this to all fall apart. So the question is how and when, and very importantly for people, don't get too caught up in the expectation that things will go on forever, because they won't.
Oh, no, no. And I think the situation, it's like a couple that get together. Everything's great, and then suddenly one has a bodily function go wrong in front of the other, then all bets are off. And that's how fragile this whole situation is. And if there's a saying, I think the market honestly is as weak as a hotel ironing board. I mean, I know you pull out an ironing board in a hotel. Normally, you've got the shitty stained iron with the ragged cord, and as soon as you try and iron your shirt, the whole thing collapses. And I think that this whole system, honestly, hasn't been built on sound fundamentals at all. It's been an absolute mortgage fest. I mean, I was able to go out and get 2.64 for 5 years. It was amazing. My mortgage payments rarely, they don't even touch the sides. But I'm shit scared for my son who could be paying over 60 grand a year in interest during the course of his loan to have a basically built shelter, 40 clicks from Perth. It's just stupidity. But if you look at the rent to live in somewhere acceptable, he's looking at 45 grand a year rent. So what choice do they have? I don't have enough room here to put them up, nor would I think living with family, unless you really, really like them, can get toxic. But I look at this whole generation and think, geez, guys, I had it good. I could walk to one of the best beaches in the world. I could walk to Bondi Police Station and I had shelter. I was walking distance to North Bondi Charcoal Chicken, which became Porto. So I had the best chicken burgers and coffee in walking distance. And this generation, has to move to Dubbo and work in the friggin' CBD. I just don't think we realise how well we had it growing up in the 90s when housing was good, crowds were good, there was no woke bullshit, and we had the grunge era. I just think we had it good, and I think now you just got to talk to your kids and say, well, look, you might have to hold off. Sit down, say, look at your income, look at all your subscriptions, go through and cancel them. Cancel your credit card, just get rid of it. But you need to lock in the chance that at one point during your mortgage, you're going to be paying up to 10% interest. You've got to factor that in, Martin. You have to. Or the flip side, you might get a 3% mortgage, but then suddenly we've got 8 to 10% unemployment. So I just think the youth of today are going into this blindsided by this magic carpet ride we've had due to the global pandemic and Labor's inability to win the friggin' election in 2019. So I just see a shit show emerging. I mean, how the hell can you afford to take your family to the AFL and feed them? It's just none of it makes sense. Only the rich could go and buy one of those. It's $55 for a fucking hamburger. Come off it.
Absolutely. Well, there are some important contexts here as well, Tony. I would come back to this slide. This is actually the economic complexity slide. And you can see here that Australia, we've slid down again, now down another 2 places. We're rank 105 down the list, right? So we're between Botswana and Ghana, amazingly.
Oh, great holiday destinations, both of them. Yeah.
But the point there is that we have really lost the plot in terms of the economic ability of Australia to generate momentum. Now, what we've done is we effectively narrowed the economic base of the economy so that effectively we have a bit of mining, and of course that mining might go off the boil, particularly if China continues to languish. We've got the LNG boom, but we're not benefiting from that because, of course, those big corps are not paying a lot, and we're paying top dollar for gas. And the other one is housing. So effectively, the momentum in the economy is houses and holes, as people always say. And the only thing that really is bubbling higher is houses at the moment. Now, but as you say, we're in this unsustainable situation where, in fact, there is very little opportunity for people to buy unless they've got significant wealth or family wealth. And so you've got a lot of people living in tents, finding impossible to rent, finding impossible to buy. So the housing dream is coming to an end for many people. And I make the point, Tony, that the current discussion around productivity, funnily enough, they've already started talking about, well, we need to freeze the construction codes to, take away the red tape. Why? Because they want to drive housing faster, because it's the only game in town. And I will just share this slide while I'm talking, because I think this is the other killer slide. This is actually this is an RBA slide showing how the Statement of Monetary Policy has forecast productivity, and how every time they're forecasting it and it goes wrong, and it goes wrong to the downside. So we absolutely do have a productivity problem in Australia, but the current talk fest in Canberra ain't going to solve it, because they're not going to actually want to deal with the fundamental structural issues that and I know are there. So it is very difficult for people, because on one hand, they can see all of this shenanigans going on, but then, you want to form a family, you want to find somewhere to live. So you're almost forced to make the property purchase dance, if you can find a way of doing it, despite the fact that it's not very sensible. And that's what I find in a lot of conversations on my one-on-ones. There are a lot of people who know that this is not very sensible, but also know they've got no choice but to follow on. So, he who pays the piper, plays the tune, and everybody follows on. But that's really worrying.
Oh, absolutely. And I guess part of me wishes that some would bite the bullet and rent, because the fall is coming. In Perth, prices are just flying. I know in my area, I'm just over 6 k's north of the city. Everything that goes up for sale gets snapped up instantaneously. I was looking at, I've always initially I harped on about areas like Camillo, Kelmscott being ideal for first home buyers. Well, Camillo's almost tripled, and all those rougher areas have done so well. And now the value within 10 k's of the CBD, there's still pockets of it, but it's getting harder. But in Perth, we're still relatively, on a historical basis, we're still expensive, but we're nowhere near the stupidity of the East. And there was an opportunity there where I suggested maybe you can sell up in Sydney, Melbourne, and buy 3 houses in Perth. Well, that window now has been slammed shut. And if you look at the long-term growth, and I go back to the house my parents built in French's Forest, which is a great barometer of the Sydney property market, the long-term growth is, even with this massive bubble, is still only 6%, well below industry super funds on the long term. So you can see just how shit property performs, how crap real house price performance is over many years, and you could have the lost decades now of growth. So where I think the money is going to be made is people that have the capacity to buy small companies that are cheap. I just think we could have eventually a PE expansion in Australia, where people think we're the safe haven of the world. You've got to buy Australian stocks, and our stocks become violently overpriced. And I still think we have the potential for that. And we also have the potential for mining stocks to catch up to the prices the miners are getting.
Yeah, so I think it's very interesting times, and the markets are relatively buoyant at the moment, of course. And if you want to sort of just check out the ASX 200, we came off the recent peak, but we're still very much in stretched territory. And it's not just us, of course. You can look around the place as well. The S&P 500 just off its highs. The VIX is way down, which of course normally in time of uncertainty would be a lot higher, but it's not particularly higher. And wherever you look, you got to say there are some interesting issues. But then here's the real killer, right? This is the 10-year Aussie bond. And I noticed that we're starting to see another peak now. And in fact, long-term bonds rates are moving higher in multiple currencies. And that's, I think, a signal of more difficulty ahead. And I mention that because I want to sort of contrast this, Tony, with another slide that I have, which actually comes from the US. But to me, this is a really important observation. And it's this one. So this is looking at, since the year 2000, the top 20%, the middle class, and the bottom 40%, and how much they've been spending. And basically, the conclusion, this is Moody's work, wealthy Americans in the top 20% continue to grow their spending. Meanwhile, middle class and lower income Americans have their spending roughly in line with inflation. And I think that's exactly what we're seeing in Australia, although the information in Australia is not as clear cut as that, simply because we don't have the same basis. But it does seem to me that we've got this bifurcation going on between a relatively small affluent sector of the economy who's doing very well. Politicians are quite often in that sector, and everybody else. And once again, I am of the view that the economy is not working for ordinary working Australians or for small businesses. And it's by design. And there isn't really much intent, certainly over this 3 days productivity talk fest, to try and deal with some of those structural issues. But there's your problem.
Unfortunately, no one is going to risk their political career to have the balls to go out and tell the truth, to make some big decisions. So I think that the collapse will happen, and that will get them out of trouble, because they'll say, well, look, it's not our fault. We always felt that asset prices were astronomical. We knew that middle income Australia is getting wiped out with cost of living, unaffordability. So I just don't think we have any political talent in the country. And why would you bother when you can go join a few boards and have a lot of free time? You're not in the public eye. But I just think that even though Trump's broken the mold of your classic presidents, we can see what happens. And there was a chart that came out of the US. It was a guy that follows housing, saying that the number of buyers and sellers in the US is way out of kilter, and it's the worst ratio in history. So if that doesn't tell you something, they're in a lot of trouble. And I know if you look at the price to income ratios in a lot of places in the States, a lot of them are trading between 4 and 7 times, and they're now in trouble from a glut of supply as well. So, once the balance tips in favor of buyers, once there's too many sellers, markets fall. And I always have a saying, real estate agents have to eat first. And if they can show that 2 or 3 houses have fallen 20% in a suburb, they can make prices fall 25, 30%. So, it is all based not on fundamentals. Yep, sure, it's a great place to live. We've got a great climate. But as I mentioned before, it's as strong as a hotel ironing board, and that will collapse. And that it will happen. There's no two ways about it. You can't say, well, look, we're going to have, was that guy in 1929 saying that share prices had reached the plateau and would stay there. Or in 1901, someone said that everything that could have been invented has been invented. I think generally people are good, inherently good, but once you start to see asset prices rise, or you see a new product come out of the market, or a celebrity endorsement, people are stupid, and that stupidity is infinite.
Well, Cookie asks a good question. What is holding the markets up? Is it the government, hedge funds, etc.? And the answer is a combination of things. Obviously, the continued government deficits, still building ever bigger, is part of the issue. Plus, of course, the banks are able to leverage off the liquidity, and as prices go up, they can effectively create more mortgages, create more loans out of space, and then on it goes again. So liquidity is part of the issue. I think also, just to stress again, we have the situation where, of course, not all stocks are actually behaving the same way. And of course, in the US, we have those mega tech stocks, the AIs, which are way overvalued on any fundamentals that I can understand. Of course, we have our own little tech stock, CBA, right? And the interesting story of CBA here. This is the CBA chart. Well, it's come off its highs. CBA was being valued as if it was a tech stock rather than actually a pretty bog standard high margin bank business, because of course people pay more margins in Australia relative to almost every other country, Western country at least. But CBA is now down to 171 from close to the 200 mark. And the story, of course, is that nobody quite knows where it's going to go next. And it's fascinating to me, I don't know whether you saw this, Tony, but a number of bank analysts have been saying for months, we don't understand how CBA can possibly be valued at this amount. It doesn't make any sense on any fundamentals. But this is not fundamentals, and that's my point, really. The main reason why the markets are continuing to bubble higher is not really fundamentals. I mean, they try and justify it. In the US, they say, well, we're going to get massive productivity improvement from AI or something, or we're going to get massive government support for, or the Fed will cut rates dramatically, despite the fact that inflation is extremely high. I have to say that the talking heads, particularly in the US on the markets, are not talking a lot of sense at the moment. And it's fascinating to me how they've all swung around now to talk about, oh, we're going to get another high, it's going to go up again and again. I am much more skeptical. I don't think that we can really justify where markets are currently are. Look at the 23 times the S&P 500. They are fully priced. And yet people are still banking on more. I'm just not sure. But I will say this. One of the real interesting levers is the passive investment strategies that many people have. What that means is that if, for example, Nvidia continues to bubble up and is a larger share of the S&P 500, all of the passive funds have to buy it. And so you've got this structural issue at the moment because of these various significant passive investors, and more people are going passive because the fees are lower. What it means is that it reinforces an upward cycle. But the reverse is also true. If markets actually did start to correct, so if the AI stocks did come back, they would have to sell, and that would actually reinforce the down cycle too. So to my mind, it's the programmatic trading and it's the passive funds that are rather driving some of these trends.
100%. And I look at I'll just go back to the Australian banking sector. Let's look at it as four hot chicks, right? Maybe we have Sydney Sweeney, Sydney Thomas. She was the ringside girl in that black and red. Maybe add Anne Hathaway for the thinking man, or Emma Alphabet, a model that I can't pronounce. But why should CBA trade at 30 times earnings and the ANZ trade at 14? 14, right? So these are equally hot chicks. Or why should the NAB trade at 17 times price to earnings ratio and Westpac 16? So NAB's 17, Westpac 16, ANZ are trading at 14 times, and we've got CBA. Now, I mean, it's ridiculous, but that's just money flow. And the perception is maybe the Commonwealth Bank has a greater share of mortgages. Maybe they're more trusted out there at the moment. I think their new ad's ridiculous. I don't like stocks. I'm an ice cream man. I mean, what the hell? Is that going to make me change banks? I don't think so. But that PE ratio is certainly a growth stock. And when you look at the banking sector, you probably, if you're looking at a PE of about 12 to 13 times, even lower, that's the buy zone. So there's no justification at all. if you were looking at a dollar cost averaging program or you're getting your kids interested in the stock market, why wouldn't you start to dollar cost average a bank like ANZ as opposed to the Commonwealth, which is the Sydney Sweeney of the Australian banking sector, whose premium is clearly not justified, Martin. And if you go back to the tech stocks in the US, again, I love AI. I love my partner uses it to write stuff. I like to write emails the slow way. I like to have fun videos of my dog or have Jennifer Lawrence shake her booty because we're all celebrating her 35th birthday. To me, there's three letters and that's FAD. And it's not a new paradigm. We said that about .com so long ago. We said the same about fidget things, Rubik's Cube, football cards, Coca-Cola yo-yos, Cabbage Patch dolls. It's not forever, guys. It's a fad. It ends. We've had massive earnings. You're right. ETFs. Don't pick stocks. Just buy a bloody ETF. But the one ETF we have used successfully in the past, and now's the time to look at it again, is the BBUS. It's now trading around in the 320 range. It was $6.80 not that long ago, and that gave my clients a chance to say, well, look, the US market will bounce. But again, I think that's a worthwhile strategy going into something where you're buying all the good news about the S&P 500, unless you're not going to see another fad. So markets are complacent. Normally after complacency, you get exhaustion, then you get a little bit of fear, and it won't take much for that market to correct, but it's inevitable because we're doing this live show saying that markets are historically way overpriced. It's been driven with superannuation funds, passive inflows into the market. A lot of it's high frequency trading. A lot of the US markets is computers and it's bound for failure, just like when you computerize other systems. So I think relevant point there is that the ASX 200 PE wise, it's about 20. It's historically overpriced, not violently overpriced, but I think we're probably going to have a decent correction before we become a safe haven. Because I think once you see the US market crumble, and it will go down with it, that will be the time to go full bore into Australian stocks. And hopefully by then, CBA's PE ratio is at a more realistic level. But you sit there and pick up ANZ or Telstra or Coles, Woolworths. That's how you're going to build wealth, not by buying property in Sydney.
Well, that takes us to a very interesting discussion that I think we want to have now, Tony, which is the difference between investing and trading, right? Because one of the things that we have seen is a lot of volatility in the last year. Prices were way down in April and they went way back up. So it's quite useful, I think, at this point for me to bring in the answers to the poll. So I basically asked this question. My financial investments are mainly in a managed super fund, 38% of the audience, mainly in a self-managed super fund, 12%, actively invested outside super, 35%, and actively trading outside super, 15%. I'm going to end the poll now on those numbers. But Tony, for me, this is a really important discussion about investing within super or not within super, and very importantly, the difference between investing and trading, because investing and trading aren't necessarily quite the same, are they?
Oh, hell no. And I I used to be involved in day trading for clients quite successfully. We'd often do it on a profit downgrade and you'd trade the dead cat bounce. But to me, trading is gambling, and I've pretty much eradicated trading from my clients completely. What we will do though is once I understand a stock and have a firm knowledge of the fundamentals, we can range trade some of that. Just say one of my top stocks gets sold down from 20 cents to 10 cents. We might buy it at 10 for that recovery. But largely, I don't recommend trading. If anyone signs up with me and they want to be a day trader, look, go elsewhere, because what you're doing is buying an asset and just hoping it goes up in price. And that's a bit like the 28,000 shit coins out there on the market based on nothing but hot air. I'm not bagging Bitcoin. I'm just saying that there's 28,000 pieces of shit that people are just gambling with. And once you get that gambling mentality, you might as well just be addicted to your sports bet app. So let's just say the ANZ Bank got sold down to a 10 times PE ratio. You might buy some for the market recovery. But what I'm seeing now, it was just interesting. Our dealer's assistant left a couple of weeks ago to join the WA police. And I'm thinking, wouldn't it be great to stay in a job like that, to rake in the super and have some stock market knowledge, knowing that after your working life, you're going to retire with a shit ton of money, but you can make money outside of that. And I think for some people, self-managed super, I wouldn't recommend it to most people if you've got that gambling mentality. And I think it's far safer to have your money in an industry fund or the bulk of it earning 8 to 9%, which is still better than French's Forest real estate long term, than have it punting. Now, if you can manage assets, understand ETFs, you understand bullion, you understand all the asset classes and can do it yourself, obviously you're going to outperform self-managed, but not many people can do that. So what I'm going to do with my children is say, look, I can teach you the stock market outside of super. I can help you with growth stocks, but go hard in your super. If you're going to sacrifice, make sure you can eat and you can turn the heater on or air conditioning. But I just think trading is a way towards disaster, because you might start trading quality assets, then suddenly you're flowing with the effluent. And as we saw with that stock that went up 8,700% yesterday, at any time the ASX could kick them off the stock exchange. I look at people trading the Star Group who are teetering on the edge, thinking, why would you buy this for a $500 profit when you could lose 100% of your investment? I just think trading is for professionals who want to sit at home, have the charts, and aim to get 51% of their decisions right. So I think at the moment, I wouldn't be rushing into Australian stocks. I don't think there's any standout value at the moment in the industrials. Obviously, I'm in the gold and silver stocks. I've got companies I think are still going to increase multiples, but that's not for everyone, Martin. And that's only for people with a high tolerance to risk, who understand that the gold price is at the moment about $336 an ounce, over 5 grand Aussie. And some of our gold companies are making $3,000 plus an ounce, and they'll start paying dividends. And that's where you'll see the inflow of funds that have caused the Commonwealth to trade like a tech stock. And it's only going to take an increase in the gold participation rate, say from 1 to 3%, and we've got a full-on bubble. But no, I do not recommend trading, nor do I want to sit there, because the only winner, if my clients want to trade, will be me.
Yeah, and of course, trading also has fees attached to it every time you buy and sell, so you've got to be careful. And you've also got to be careful about the capital gains or losses, because you've got to actually report those into your tax processes as well, and that can be quite complicated. I've had a few people tell me stories about being caught out because I didn't do the math well enough to be able to actually deal with that stuff too. So it can get messy quite quickly, right? If you've actually got to deal with that too.
I think this, yeah, I'm not afraid to share this story, but I floated a biotech stock called Exafarm at a cent. I got my shares for a cent. I had faith in the guy that founded it, and my shares went to $1. And I sold all the way up. I didn't. I actually, my last major sale was when I rounded my holding down to 1 million shares at $1. I sold some shares at $1. Then I rode most of those shares into oblivion. Obviously, I was put behind Chinese walls. I was trying to help the company. But what happened was I came out, I was earning quite good money as well, but I came out with the mother of all tax bills, and there was no way around it. There was absolutely no way around it, and that tax bill was $299,000, Martin. And I've down now, I've got one more payment of $1,094 to go. And I've smashed that in 2 years, and that's the lesson. That's my lesson, that when you make well over $1 million on something, you shouldn't take it, put something away for the ATO. But I know that my years of child support, those three expensive words, I love you, are coming to an end. My tax bill's done and dusted. I thought, stuff it, I don't want to prolong it. And suddenly I'm going to have enough income to go to the Brisbane show and buy an Ecke burger. So, lesson for everyone: don't gamble with stocks, and remember, you have to pay tax, kids.
Yeah, there is no way around. Now,
No,
interestingly, there was a question earlier on from Fred. I'm not sure whether you're able to give a commentary on it, but he asked about Pac Gold's new acquisition. Know anything about it? I don't.
I do. Brilliant gold asset in North Queensland. I helped float this company. It's a 25-cent issue. Those shares peaked at $1. So some of my clients made a lot of money. They're going into antimony, a critical metal that's done exceptionally well, and it is in that North Queensland region. So honestly, at this point, I haven't looked too deeply into it. I knew former management. I know the current management. I think that their current Alice River Gold project has massive potential. You've got 30 kilometres of strike. They've just raised money at 6. They're actually trading nicely above that. But if antimony has another kicker, I think the shares will do even better. But what you need to be mindful of, guys, is that when a market matures and you are the last person involved, it's like showing up at 3 a.m. to a piss up holding a vegan pizza. No one wants it. All right. So that's like when .com ended, uranium, potassium, phos, all these bullshit bubbles ended. No one wants it in the end. So obviously this has got significance in its location, and that sector has had a couple of goes, but it's not at the end of its stage. So, at some point, mining companies are going to start pegging tenements on the moon, or they'll they claim to a meteorite that contains $1 billion worth of gold. But I think that Pac Gold, got to $1, has come all the way back. I'm very bullish on their gold project, and management just wouldn't pick up any moose pasture. So no, I'm positive on it, Martin.
Okay,
But
great.
just be mindful that if you buy the top of a fad, you're going to get slaughtered.
Yes, AI stocks, please note.
Yeah. Well, I made a cute video of my Akita. Yeah, that's it. That's going to drive it to $1 billion in value. Oh, fuck me. What can I say?
Well, indeed. Now, Cookie asked this question: are you on the platinum train? So, what's your latest thinking with regard to metals and, perhaps some of the rare metals as well?
Well, platinum, obviously, this is. I found this hilarious that platinum frequent flyer is still higher than gold. Don't the airlines realize that the gold price has been higher than platinum forever? But it's used obviously in catalytic converters in cars. There has been some doubts as to the usage with this EV revolution. There hasn't been any fantastic pure platinum plays in Australia. However, one of my latest recommendations, which is out there in the public domain, if you follow me on X, is Legacy Minerals. Code is LGM. They're drilling for some platinum group elements in New South Wales at the moment. So I think the hype with your platinum palladium will come from mainly the explorers because we haven't had that exposure to the producers. So I'm on that train, but I accidentally fell off. I accidentally fell asleep on the last journey. So yeah, I'll ride it. But yeah, Legacy LGM one to look at. They're about 15 cents, but I have recommended it in some columns, and you'll see me talk about it a little bit more.
Yeah, thank you. The dogs have gone off because the bin collection is happening in the minute. So, sorry about that. Uh, it's part of the problem at this time of day. The bins are here. So, Tony, as we come to sort of towards the end of the show, then what we're really trying to say, people, is people be a little bit cautious, a bit careful. Don't be lured into this artificiality that we've got here. What's your best advice to people at the moment? They're in the market at the moment. Should they buy down protection, options, or should they just hold? Or I mean, how do you think about it when you're at these exalted heights in the market?
Well, I think pretty much, you've got time, and there's been no greater uh, destruction of wealth than in the search for yield. So I'd almost say that anyone that's got a heap of cash to sit on it at the moment. I don't think there's any rush. If you're going to go for the ASX 200, I'd actually hold off. I don't think there's going to be any real value drivers. I think the US market's totally exhausted now, and it probably needs a rest. It needs a few weeks to the downside. So there's no real shame in sitting on cash. Um, you know, People might say, well, I'm not going to sell my Commonwealth Bank shares because I don't want to pay capital gains tax. Well, what happens when they're $170 and suddenly they're $120? So I think tax, it screws with your mind. So unless you're a stock picker, sit on some cash. If you're prepared to take a higher level of risk and think, hey, wait a sec, this world's batshit crazy, look at the BBUS ETF, look at the parameters. You have to do your own research, but I think around $3.20, $3.30, in the event of some volatility increasing, I wouldn't be surprised to see that increase 50 to 100%, Martin, and then keep going. Because at the moment, those that bought at the peak have suffered terrible losses. But if you look at it, we've had a 4-year bear market in ASX small caps. We're now in a bit of a bull market. And we've had this never-ending, it feels like a never-ending bull market in ASX 200, bank stocks, tech stocks. So unless you're willing to come into some individually picked gold shares, which I'm heavily involved in, stick to cash. If you're in a company that's not trading at a ridiculous level, hold on to it. But I think at the moment, the best buying of the market is certainly not now. And if you're happy to get 5% plus in a term deposit or an at call savings account, do it and wait for the buying opportunities, because CB8 30 times isn't a bargain when it's the most expensive bank on the planet. So yeah, don't be afraid to hold off. I've obviously got my pet favorites. I don't need to push them here. If anyone wants to reach out, I have a website. I think you've put that somewhere there, Martin. But yeah, I just find myself now with my job, my gym habits. I'm playing paddle now 4 or 5 days a week, and in fact, in a couple of weeks, I'm off to play at the Australian Masters, and I'm looking forward to hopefully coming up against Pat Rafter in a couple of weeks, and or at least meeting him. So, I mean that will give me more of a thrill than certainly buying a new house in East Willandra or East Dubbo, East Broken Hill. So. No, I'm just enjoying life, Martin. That's all you can do. It's I've got to look at how many years have I got healthy and playing with a full bag of marbles. But some people might say I'm crazy, but I just like to look at psychology. I like to look at how people live, their habits, what's driving markets, and at the moment, I think I'm well placed. I told people to buy silver. The price of a 1 kilo silver bar for us has effectively doubled, and there's probably more in it. But again, you've got all these risks. But it's just absolutely crazy times at the moment. But I just can't say there's no bargains really outside of the stocks that I understand and can value on an A4 sheet of paper.
And Cookie just asked one other question. Averaging down, yes or no? What's your thoughts there?
I've had the greatest success. My greatest success stories as a stockbroker have been averaging down. The greatest winner I've had of all time has been Ramilius, which went 50 times for us twice after it collapsed. But if the assets are good and you believe in the story, yes. But what you have to understand is that the savage bear market in small cap stocks has caused a lot of people to get involved in these companies just there for the fee and flip model. And the fee and flip model is where you take a 5-6% capital raising fee and sell out the stock and move to the next one. So a lot of stocks are now trading at levels they shouldn't be, especially the biotechs where the science is good. But at the moment, my favorite gold stock, Saturn Metals, and I actually went out to their potential mine site out near Leonora a couple of weeks ago, actually about a month ago. They had a driller. Unfortunately, there was a death on site, and the company's share price got sold off quite heavily. And we also had a US fund sell most of their holdings down to 18 cents. I said, look, I understand the asset, I understand the growth potential, and I got everyone to average down. So sometimes it's going to blow up in your face, but I think you need to have a deeper insight into the company. You need to have faith in management, and unfortunately, a lot of speculators and investors out there, Martin, are too lazy to do that, and that's where I come in. And sometimes, you keep catching a falling knife, and there's lots of things that can happen outside of your control. And that's why I reiterate that you need to take a portfolio approach. We had obviously Exafarm failed, our cholesterol drug company failed, went to 2 cents, and is now just come off a high of 37 because their brain injury drug is showing promise. You're always going to get slapped in the face, you're always going to get beaten up. But if you want to become a millionaire, the best way to do it is to become a solid investor in small cap companies or buy a ticket in the MSWA lottery where your odds of winning that $3.6 million house and cash in Florida, I think, is about 1 in 250,000, which is pretty good odds.
Tony, thank you. It's been
Yep.
very, very interesting as always. And I think both you and I share the view that we are in wobbly territory at the moment, bubbly territory. Doesn't mean it's going to fall tomorrow, but it does suggest that there aren't many bargains around unless you know clearly where to look and what to do. And there are a few around the edges, but for a lot of people, it's probably a time to be a little bit more skeptical about future rises. I think the pain trade is probably higher from here. I think we're probably more likely to go sideways. And bearing in mind that this 3 months of the year tend to be the most wobbly, as I said at the start of the show, and particularly in the US with where they are at the moment. So very, very thoughtful. And as always, it comes back down to people being a little bit more attuned to what's going along and not being swept up with what the mainstream is saying or what the socials are saying or, what they're saying down at the barbecue. Do your own work, do your own research, and do your own thinking, and play your own furrow.
Yeah, and I was actually thinking. I think on the last show, someone said, "Well, how would you play lithium?" And I said, "Well, I wouldn't play any of the shit stocks, but I'd certainly buy Pilbara." And I think at some point, those that had the balls to go in at one point would have almost doubled their money. So I know I do talk a lot, but sometimes there are some little gems you might come away with from time to time.
Well, I
So,
think there are plenty of gems, Tony. But as always, people need to do their own, their own research, etc., etc. But the point is that, can you handle the truth? Well, we think most people can handle the truth if they're told the truth. The problem is that many people at the moment aren't being told the truth, and that's for me the problem. And that's why these shows are important.
yeah, couldn't agree more. And I appreciate the opportunity, and I look forward to getting back and having more chats. And at some point, we're going to be doing a show saying how cheap the ASX 200 is. I can't wait for that.
Okay, well, we'll probably have you on whether it's for that story or for another story. We'll see. But anyway,
Yeah.
Tony, thank you very much indeed. Links and things are below if you want to get hold of Tony. And I'll look forward to getting you on the show down the track. I'm going to take you offline now. I'm going to close the show today. Thanks, Tony.
Thank you.
So there you go. I hope you found that interesting and informative and a bit thought-provoking. That's what the idea of this channel is. Just to say that next week it'll be Robbie Barwick. I want Robbie to come back on. There are some really important developments that I want to talk about with him. And so I think it's worth having him on to talk about that. And just to say that I've got one dog. The other dog went around the corner. So there is a dog, but not two dogs. That's Meteor, now sound asleep. You wouldn't have ever thought that she'd ever barked in her life, would you? Yeah, but we know different. Anyway, thank you very much for spending time with us this evening. Hope you found that informative and interesting. Have a good evening. Have a good week. And we'll see you on the live stream next week. And of course, we'll be releasing videos every day of the week in the meantime. I'm interviewing Tarek again on Friday, so look out for that. And there are a couple of other people I'm chatting with too as well. So there'll be other shows coming along. This is Martin North from Digital Finance Analytics signing off, and we'll see you next time. Take care.